Thanks for joining us on the show. Can you give us some highlight as to what's your take on the results this time?
Sure. So this quarter, we have added a net headcount of close to 18,000. And for the first half of this year, we did add about 31,000 headcount between our staffing and apprenticeship business. And on a year-on-year basis, it's close to 48,000 net addition. So in terms of volume growth across all the sectors, we are seeing very good demand. BFSI on the back of RBI regulations, especially regarding outsourcing of sales profiles, will have an effect on our BFSI headcount growth in Q3. So that's the reason we said BFSI can be muted in Q3. Having said that, be it in consumer vertical, retail, telecom, and manufacturing and other emerging verticals, we are seeing very good growth. And even net of BFSI drop, we believe that there should be at least 8 to 10,000 net headcount growth in Q3 as well. And by Q4, we expect recovery to bounce back, including BFSI across all other sectors, and we should be able to continue with a year-on-year growth of 18 to 20% headcount growth and revenue growth upwards of 20%.
Right, but let's talk about the BFSI vertical over here. I guess BFSI is largely picking up even for other IT companies. So, what's your take on the BFSI segment? Are you seeing more kind of hiring? Because more hiring will likely imply that the demand is now picking up for the IT sector as a whole.
Yeah. No, let me unpack this into two parts. So one is BFSI within our IT staffing and BFSI in our general staffing. So right now we are seeing some sort of headwinds on the non-IT side of BFSI related hiring, and that was specific to Q3. Again, starting Q4, we are expecting the numbers to come back in BFSI non-IT profiles. Now, coming back to IT profiles, actually, we are seeing very good growth within IT, mainly coming from the GCC segment. And we believe this hiring trend in GCC, BFSI, IT will continue even for Q3 and Q4. And in fact, we are expecting positive headcount recovery starting 1st of Jan, starting Q4 this year.
Mr. Ramani, thank you so much for joining us today here, and season greetings to you and everybody at TeamLease. It's Puneet here. You did mention about the headcount addition expectations is strong for the second half as well. I just wanted to check on your new logos addition this particular quarter. You've had decent additions as well. What's the outlook on that over the next 2 quarters for this fiscal year? And any kind of commentary that you can give us on that?
No, our new logo addition has been strong over the last 1.5 years, and we will continue that momentum even for second half of this year as well. We are focusing a lot on the manufacturing segment, auto and engineering segments, especially in terms of new logo acquisition, and we are seeing very good traction there. And again, within IT, a lot of new GCC clients are also getting onboarded. We have a good pipeline of new GCC customer addition even for second half of this year. So we are very positive to continue the current momentum of new client addition for the second half as well. Apart from our staffing businesses, even in our apprenticeship business, so we are acquiring a lot of ITES clients because so far in our apprenticeship business, we used to have a lot of concentration with auto industry, and now we are building a lot of pipeline with IT and ITES clients as well for the apprenticeship business, which is very good because these clients tend to give us a higher learning component and higher realization for our apprenticeship business.
Right. Hi, Mr. Dathi. This is Harsh here. Ma'am, just want to quickly understand from you, where does therefore top line go maybe 2 to 3 years from now, and where outside of GCC are the other pockets of opportunity that you're focusing on?
Yeah. So for us, the revenue growth, we would like to maintain consistently warm between 20 to 25% of top line growth over the next 3 to 5 year time frame as well, but with a higher focus on margin expansion and absolute profit expansion because we hit our rock bottom in Q1 of this year with all the impacts coming from be it IT staffing or apprenticeship business and other impacts. And now we are focusing on expanding our profits quarter on quarter. So this year we posted about 30% sequential growth, and we believe we should be able to maintain at least a 20% sequential growth in profits for the next quarters as well. And overall, for the next 3 to 5 years, we believe there'll be a higher contribution coming from IT staffing and HR services, which have relatively a higher margin profile compared to general staffing, leading to the overall margin expansion at group level.
Right, Ms. Dathi, one question on the specialized staffing services. Well, this one contributes about 5.1% to the total revenue in the second quarter, and the margins here have also, gotten a little better at 7.9% in terms of EBITDA versus 6.4% last time. But this has been a little under pressure, as the management had mentioned on the call, because of cautious demand in the IT vertical. So, what's your sense on the specialized staffing? Do you think that this can be margin accretive and grow in terms of volumes going ahead?
Yeah. For us, specialized staffing, as you rightly mentioned, gives us about 5% in revenue, but in terms of profit contribution, it gives almost 30% share. And right now, that particular vertical is under pressure because of the headwinds in IT industry, which we believe will continue till Q3. But starting Q4, we are expecting a recovery. And with the increase in top line and growth in the volume, even the EBITDA margins can be expanded further. So currently, we are at about 7.8, 7.9% EBITDA margin, which can be improved to 8.5 to 9% over the next 1 year time frame.
Okay, so you will see pressure in this vertical, but in terms of margin, can we expect Q3 margin in this segment to dilute in the next quarter?
We are not expecting any dilution in margin in this segment for next quarter. So we can maintain the current margin profile for next quarter as well.
Right. Okay. And in terms of the other HR services, which you mentioned, has kind of a good volume, and also the outlook is good over here. Well, when I look at the EBITDA margin, it was negative last quarter, and you've posted like a flat kind of margin this time. So good improvement over here. So do you expect this kind of positive EBITDA margin to sustain, or how is the EBITDA margin profile looking like in the other HR services segment?
Yeah. In other HR services, this year we should be able to maintain at least a 6% overall EBITDA margin. And mainly this contribution is coming from our EdTech business. A lot of new universities have been signed and the billing has started in Q2, end of Q2 and Q3. We believe that the profitability will be much higher, both on a sequential basis as well as year-on-year basis. In fact, this year, 100% of our EdTech profits get booked in second half of the year. So that should give us a higher bump up in margins and absolute profits in H2.
Mr. Ramani, just one final question from my side. In Q3, what is the expectation of sectoral growth that will be driven? And talk to us a little bit about BFSI as well. There has been some clampdown by the RBI in terms of guidelines as well in certain segments and pockets, which were, high hiring segments. So just talk us through which segments do you anticipate in the short term to grow for you in Q3 and Q4? I think consumers and telecom is something that you mentioned, but talk to us on BFSI as well. What is the outlook for the next 2 quarters?
Yeah. BFSI, as I mentioned, in non-IT profiles, Q3 can be muted, or in fact, there can be a slight drop in our BFSI headcount. So currently in our overall headcount, we have 20% exposure to BFSI. And here are the profiles that we are expecting that there can be a drop is mainly into sales, the BFSI sales, the credit card sales, loan recovery. These are the profiles where we are expecting some dip. But other than BFSI, be it consumer, retail, manufacturing, ITES, and other emerging sectors, telecom, we are seeing very good demand in Q3 and Q4 as well. Even within IT, the GCC segments, the demand for the profiles in IT and ITES is very good for Q3 and Q4.
Ms. Dathi, one follow-on with regard to the EdTech EBITDA, which you were speaking about, likely to recover in H2. Could you give us some color on this? Could you give us an understanding? You said revenues will likely be recognized in Q3, Q4, and therefore margins will be much better, profitability will be much better in those quarters. Could you talk to us about where, therefore, what will be the impact on margins, and give us context on this, please?
Yeah, sure. In our EdTech business, our billing cycle follows the student admission. And this year, specifically this year, UGC has given guidelines to all universities to realign their curriculum matching with the new education policy. So because of that, many universities have delayed the student admission cycle by 1 or 2 months. So that has to some extent deferred our revenue billing from Q2 to Q3. So even if you look at our Q2 performance in HR services last year, in terms of profit contribution, it gave almost close to 15% profit contribution at group level, but this time it's kind of muted because of this deferral in university revenue billing. However, Q3 and Q4, we are expecting between these 2 quarters close to a 15 crore of profit contribution coming from EdTech vertical alone.
Therefore, where should margins lie, ma'am? Q3, Q4? What should be the improvement?
Margin as a percentage, it's very difficult for us to give a guidance,
Sure.
but on absolute profits, we are expecting at least a 20% sequential growth on profits, on absolute profits.
Okay, understood. Thank you so much, ma'am. Been a pleasure chatting. Thanks so much for coming in and speaking with us.